Seizing big opportunities, life's big opportunities, have to be seized. We don't get many chances, but when we do, we have to go for it. Even doing something too small can be just as big a mistake as not doing it at all. Now imagine this. You wake up and your financial worries are gone. Your bills? Paid. Your dream life? A reality. Your future? Secured. And do you know what made it all possible? The power of dividends. In 2020 alone, S&P 500 companies paid out over $58 billion per month in dividends to their shareholders. Here's a staggering fact. Historically, dividends have accounted for 42% of the stock market's total return. That's almost half of all stock market gains, just from dividends. So the real question is, how do you tap into this wealth-building machine? How do you secure a monthly payout of $4,400 without working overtime or getting a second job? Stick around, because today we're going to dive into the game-changing strategies that can make it happen. The road to financial freedom. This journey is guided by the wisdom of a financial legend, Warren Buffett, as we uncover the fastest way to achieve true financial freedom. Because the truth is, wealth isn't just about how much you make. It's about how much your money does for you. And today, we're going to unlock the secret to making that happen. Turn your investments into a steady income stream. Imagine a steady stream of income from your investments, money that flows into your account without you having to lift a finger. Our ultimate goal? A monthly payout of $4,400. Let's dive in. What are dividends and why do they matter? First, we must understand what dividends are and why they're crucial for achieving financial independence. As the legendary investor Warren Buffett once said, "If you don't find a way to make money while you sleep, you will work until you die." Dividends are the answer. So, how do dividends work? When you invest in a company stock, you're not just buying a piece of paper. You're becoming a part owner of that company. When the company makes a profit, it has a choice. Keycap 1. Reinvest the profits into growing the business. Keycap 2. Distribute a portion of those profits to shareholders. This is what we call dividends. How often are dividends paid? Dividends are typically paid out on a regular basis, often quarterly. But some companies pay them monthly or even annually. And while most dividends come in the form of cash, some companies offer additional shares of stock instead. Dividends, your slice of the pie. Some companies pay dividends in cash, while others offer additional shares of stock. This is known as stock dividends or dividend reinvestment plans, DRIPs. Dividends are your slice of the pie, a way for companies to share their profits with investors. Dividends matter for wealth. Building dividends aren't just a bonus. They're a steady source of income. This makes them an essential tool for building wealth and achieving financial freedom. It's a strategy that Warren Buffett himself has used to accumulate massive wealth over the years. As Warren Buffett himself has said, backhand index pointing right, I do believe in dividends in a great many situations, including many of the companies in which we own stock. The power of a strong portfolio. Warren Buffett emphasizes the importance of building a strong portfolio, but not just any portfolio. He famously said, backhand index pointing right, diversification is protection against ignorance. It makes little sense if you know what you're doing. What does that mean? You don't need to invest in everything, just the right things. Take See's Candies, for instance. If it were a standalone company, Buffett explains they'd pay out almost all their earnings as dividends, just like they do now. Instead, that money flows to Berkshire Hathaway to be reinvested wisely. Buffett's philosophy? Companies should pay dividends when they can't efficiently use the money for growth. In some cases, that means paying out 100% of earnings, and in others, it means reinvesting for expansion. So, how do you use this knowledge to build your own dividend-paying portfolio and start generating passive income? Let's break it down. Build a dividend portfolio that stands the test of time. A strong dividend portfolio isn't built overnight. It requires a well-thought-out strategy. So, let's get straight to the nitty-gritty of creating a powerful dividend-generating machine. Follow the tried and tested principles that Warren Buffett relies on, and you will be on the road to success. The first and most crucial step is selecting the right dividend-paying stocks. Look for companies with a proven track record of stable or growing dividends. You'll find these in industries like consumer staples, utilities, and healthcare, which remain strong regardless of economic conditions. The key is to research thoroughly. Understand a company's financial health, its competitive advantage, and its ability to generate consistent cash flow. As Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Focus on businesses that can weather economic storms while continuing to reward investors. Diversification is the second critical factor. Buffett once said, "Diversification is protection against ignorance." It makes little sense if you know what you're doing. For most investors, spreading investments across multiple industries is essential for reducing risk. A well-diversified portfolio is key to balancing returns and protecting against downturns. If one sector struggles, your portfolio remains stable. The goal is to find the perfect balance, diversified enough to minimize risk, but focused enough to maximize returns. Think of it like building a financial fortress. Each investment is a brick that strengthens your foundation. Now that you've mastered stock selection and diversification, you need to learn how to maximize returns and accelerate wealth building. If you want to take control of your financial future, stay tuned. What we're about to reveal next will change everything. You can build a resilient dividend portfolio for long-term wealth. To create a dividend portfolio that stands strong against market fluctuations. You need a careful strategy. Dividends provide a steady income stream, but the value of your investments can rise and fall. Diversification is your safety net. 1. Diversification is the key to safeguarding your wealth. A well-diversified portfolio distributes investments across multiple sectors. When one industry struggles, others can help balance your returns. While some investors prefer to concentrate their holdings, diversification is a proven way to minimize risk and ensure long-term stability. 2. The long-term perspective is crucial that A.S. Warren Buffett insightfully noted. If you had a punch card with only 20 punches for your entire life, you'd think carefully before making each investment decision, and you'd make good ones. The best investors don't chase short-term gains. They play the long game. Dividend stocks, when held for the long term, generate consistent income and benefit from compounding growth. Reinvesting dividends can create a powerful snowball effect, significantly increasing your returns over time. As Buffett famously said, our favorite holding period is forever. 3. Assessing risk. Not all dividend stocks are created equal. One of Buffett's golden rules is to avoid companies drowning in debt or those with a history of cutting dividends. These are major red flags that signal instability. Focus on companies with a strong balance sheet, a history of increasing dividends, and sustainable cash flow. Stability always wins over speculation. The key to financial freedom isn't just making money, it's keeping and growing it wisely. By following these principles, you can build a dividend portfolio that generates passive income, withstands market downturns, and accelerates your path to wealth. Build a powerful dividend portfolio for financial freedom. Create a dividend portfolio that thrives in any market. While dividends provide passive income, the market is unpredictable, so smart investing is key. Follow these 5 essential steps to build a portfolio that can generate wealth and financial security. 1. Diversification. Your safety net. A well-diversified portfolio is your safety net. It protects against market volatility by spreading investments across different sectors. When one industry underperforms, the others will keep your portfolio stable. Focus on reliable, dividend-paying companies in industries like consumer staples, healthcare, and utilities. Avoid chasing trends. 2. The long-term perspective is crucial that A.S. Warren Buffett famously said, "Our favorite holding period is forever." The most successful investors don't chase quick gains, they build wealth over time. Reinvesting dividends allows you to take advantage of compounding, turning small gains into substantial wealth. This snowball effect will significantly boost your income over the years. 3. Assessing risk. Avoid dividend traps. Not all dividend stocks are safe bets. Companies with excessive debt or a history of cutting dividends can put your portfolio at risk. Focus on companies with a strong financial foundation and a consistent history of increasing dividends. Stability always wins over speculation. 4. Preparing for economic downturns. Market crashes and recessions are inevitable. A well-structured portfolio can weather any storm. Invest in companies with resilient cash flow, low debt, and strong consumer demand. Invest in businesses that continue paying dividends during downturns to ensure financial security. 5. Monitor and adjust your portfolio regularly. The market evolves. Your portfolio must evolve with it. Regularly review your investments to ensure they align with your financial goals. Some companies may stop growing, while new opportunities emerge. Stay proactive and adjust your portfolio accordingly. The blueprint for living off dividends: achieve true financial freedom through dividends. A solid strategy is essential to turn your investments into a steady stream of passive income. A crucial step in this journey: invest in blue-chip dividend stocks. Why blue-chip dividend stocks? These stocks are the foundation of your financial house, built to last. Blue-chip companies are industry giants with a proven track record of financial stability, consistent dividends, and resilience during market downturns. They are the antithesis of the risky, unpredictable stocks that plague the market. Blue-chip dividend payers are reliable and provide a steady income stream, making them a cornerstone of any portfolio. As Warren Buffett wisely puts it, the most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd nor against the crowd. The mindset for dividend investing isn't about chasing quick gains. It's about long-term wealth building. Buffett emphasizes that investors should buy stocks with the expectation of holding them for an extended period. He emphasizes that investors should not be preoccupied with the immediate gratification of short-term gains. It all depends on your circumstances. But you shouldn't buy stocks unless you intend to hold them for the long term, and you are prepared both financially and psychologically. Invest in strong, dividend-paying companies and let compounding work its magic. The longer you hold on to your investments, the more your money grows, transforming dividends into a relentless cash flow machine. Now that you understand why blue-chip stocks are essential, let's take it a step further. How much do you need to invest to earn $4,400 per month in dividends? Let's break it down step by step. The power of blue-chip dividend stocks investing requires the right mindset. Forget short-term market trends. Focus on companies with proven resilience, the kind that have stood the test of time. Blue-chip dividend stocks are the way to go. These are the financial titans, companies they have white heavy checkmark massive market share, white heavy checkmark competitive advantages, white heavy checkmark decades of consistent dividend payments. Adding blue-chip dividend stocks to your portfolio is not just investing, it's building a financial fortress. These stocks provide stability, passive income, and long-term capital appreciation, making them a cornerstone of financial independence. Warren Buffett's Golden Rule. Buffett's philosophy is simple. The best investment strategy is finding high-quality businesses and holding them for the long haul. This time-tested strategy will create a steady stream of passive income, bringing you closer to the ultimate goal, living off dividends. Your next step is clear. Start researching blue-chip stocks that fit your portfolio. Companies that chart increasing history of increasing dividends, money bag, strong financials, and growth potential lock stability, even in downturns. This is how you turn investing into financial freedom. Now the big question, how much do you need to invest to earn $4,400 per month in dividends? Let's break it down step by step. The power of dividend growth stocks. Invest in dividend growth stocks to build wealth. Stable blue chip stocks provide consistent payouts, but dividend growth stocks are different. They increase their dividends over time. Invest in dividend growth stocks for the best way to build wealth. These companies don't just pay dividends, they raise them consistently. This means chart increasing your income grows over time without investing additional money. Money bag, you benefit from compounding as your dividend payouts reinvest and multiply. They prioritize innovation and expansion, making them excellent long-term investments. Warren Buffett's take. Buffett famously said, "The best investment you can make is in yourself." In investing terms, that means backing companies that invest in their own growth, because as they grow, so do their dividends. How to spot a strong dividend growth stock. Look for companies that white heavy checkmark a history of annual dividend increases. White heavy checkmark operations in expanding industries with strong future potential. White heavy checkmark a commitment to reinvesting profits into research, development, and expansion. The power of compounding. As these companies steadily increase their dividends year after year, your income grows, not just in dollar terms, but as a percentage of your initial investment. This compounding effect will accelerate your journey to financial independence. Lightbulb next step? Start researching high-quality dividend growth stocks and build a portfolio that pays you more every year. Unlock your financial independence with dividend growth stocks. If achieving financial freedom is your goal, investing in dividend growth stocks is the most powerful strategy you can adopt. Forget the large but often stagnant payouts of high-yield stocks. Dividend growth stocks provide increasing income over time. They reward investors who understand the power of compounding and time. Invest in dividend growth stocks for the best chance of achieving financial freedom. Chart increasing your income grows consistently as these companies increase their payouts. Lightbulb compounding accelerates wealth building, multiplying your returns. They focus on innovation and expansion, ensuring long-term success. This strategy aligns perfectly with Warren Buffett's wisdom. Buffett has always emphasized a long-term perspective and continuous learning as the keys to wealth. By investing in companies that prioritize sustainable growth and rising dividends, you're not just buying stocks, you're investing in your financial future. The power of patience. Dividend growth stocks may not have the highest initial yields, but their ability to generate substantial income over time is unparalleled. As your investments grow, so does your passive income, paving the way for a life funded by dividends. What's next for you? Add dividend growth stocks to your portfolio and set yourself up for a lifetime of increasing income. The earlier you start, the faster compounding works in your favor. Backhand index pointing right next up. A game-changing strategy to supercharge your dividend income. Boost your dividend income with covered call ETFs. Boost your dividend income now by using covered call exchange-traded funds ETFs. This unique investment approach combines the power of dividend-paying stocks with the additional income generated from selling call options. And guess what? This strategy aligns perfectly with Warren Buffett's timeless wisdom. Warren Buffett's wisdom, the legendary investor, has famously stated, "The stock market is designed to transfer money from the active to the patient." In the case of covered call ETFs, patience pays off handsomely as these funds generate additional income for investors. What are covered call ETFs? They're investment vehicles that blend stocks and options to maximize returns. Here's how it works. The fund holds a collection of high-quality dividend-paying stocks, the foundation of its portfolio. At the same time, the ETF sells call options on those same stocks. A call option gives the buyer the right, but not the obligation, to purchase shares at a predetermined price, known as the strike price, within a set time frame. By selling these call options, the ETF collects premium income from buyers. This premium income is then distributed to investors as dividends. This strategy effectively boosts your income. This strategy generates additional income by taking advantage of the option premiums, giving you more dividend payouts without needing to increase your initial investment. However, there's a catch. While the income can increase, selling call options caps the upside potential of the stocks in the portfolio. In other words, if the price of the stock rises dramatically, the ETF may have to sell the stock at the agreed-upon strike price, limiting your potential gains. Is this strategy right for you? Covered call ETFs are ideal for investors who prioritize income and are willing to trade some upside potential for higher, more predictable income through real examples of covered call ETFs. Now that we've covered the basics, it's time to dive into real examples of covered call ETFs that will help you boost your dividend income. 1. Global X S&P 500 Covered Call ETF XYLD. The Global X S&P 500 Covered Call ETF XYLD is a leading fund in its field. This ETF follows an index that tracks S&P 500 stocks and implements a covered call strategy on those holdings. 12-month trailing yield, approximately 12%. Objective. The strategy's objective is straightforward. Deliver an attractive yield potential while maintaining exposure to the S&P 500 stocks. How it works. This ETF holds a basket of large-cap U.S. stocks while selling call options on those stocks to generate additional income. Investors benefit from dividends while gaining exposure to the broader stock market. Choose covered call ETFs like XYLD for reliable income and potential growth. If you're looking for a steady income stream, XYLD and similar ETFs are the way to go. They enhance your dividend payouts without excessive risk. These ETFs capture option premiums, boosting income without needing to sell your stocks outright. However, remember that selling calls also means limiting your upside potential if the stock price rises significantly. If you want to maximize your income from an existing portfolio, covered call ETFs are the way to go. They offer a unique opportunity to generate more dividends without changing your overall investment strategy. Covered call ETFs, a powerful addition to your dividend strategy. Covered call ETFs will boost your dividend income strategy. These funds hold dividend-paying stocks and sell call options on those stocks, generating additional income through premiums. While this caps potential gains if the stock price rises significantly, it offers steady income through dividends. As Warren Buffett wisely notes, patience is a crucial aspect of successful investing. Investors willing to trade some upside potential for consistent income will find covered call ETFs a great tool. Examples of covered call ETFs. Global X S&P 500 Covered Call ETF XYLD. This ETF follows the S&P 500 and sells covered call options, aiming to provide an attractive yield while maintaining exposure to large-cap U.S. stocks. ProShares K1 Free Crude Oil Strategy ETF OILK. This ETF provides exposure to crude oil through futures contracts and covered calls, appealing to those interested in commodities. iShares MSCI Brazil ETF EWZ. While not a covered call ETF itself, it shows how you can explore covered call ETFs focused on international markets for portfolio diversification. Achieve $4,400 per month in dividend income. Here's how to reach your goal of $4,400 per month in dividends. Annual income goal. $4,400 per month times 12 months equals $52,800 per year. Estimated yield. If your portfolio yields an average of 6% per year, the required investment is clear. $52,800 divided by 0.06 equals $880,000. Invest $880,000 in dividend-paying stocks or ETFs to earn $4,400 per month. Final thoughts. Covered call ETFs and dividend growth stocks are powerful tools in your journey to financial independence. Focus on long-term, patient investing to steadily build a reliable income stream. Reinvesting dividends will accelerate growth, helping you achieve financial freedom. Start today and let your investments work for you. Covered call ETFs versus traditional dividend investing. Generate $4,400 per month in income. Covered call ETFs with 12% yield. Annual income required. $4,400 per month times 12 months equals $52,800 per year. The investment needed for a 12% yield is clear, $440,000. To generate $4,400 per month from covered call ETFs with a 12% yield, you must invest $440,000. Traditional dividend investing with 3% yield. Annual income required. $4,400 per month times 12 months equals $52,800 per year. Investment needed for 3% yield. $52,800 divided by 0.03, 3% yield, equals $1,760,000. With a 3% yield, typical for blue chip stocks, you'd need to invest $1,760,000 to generate the same $4,400 per month. Comparison. With covered call ETFs 12% yield, you'd need to invest $440,000. With traditional dividend investing, you'd need to invest $1,760,000. Covered call ETFs offer a more efficient way to reach your dividend income goals, requiring a significantly lower investment. Covered call ETFs versus traditional dividend stocks. Which is right for you? If your goal is to generate $4,400 per month in passive income, you must decide between two popular strategies: covered call ETFs or traditional dividend stocks. Let's examine the numbers. Covered call ETFs with a 12% yield. Covered call ETFs hold dividend-paying stocks while selling call options on them. This strategy generates extra income through premiums, making it appealing to income-focused investors. To achieve $4,400 per month. Monthly income, $4,400. Annual income, $4,400 x 12 equals $52,800. Yield, 12%. Investment needed, $52,800 divided by 12% equals $440,000. Traditional dividend stocks with a 3% yield. Traditional dividend stocks, like blue-chip companies, offer stable income and potential growth. Let's calculate the investment needed at a 3% yield. The monthly income is $400 to the annual income is $4,400 x 12 equals $52,800 that the yield is 3%. The investment needed is $52,800 divided by 3% equals $1,760,000. Comparison. Covered call ETFs. A $440,000 investment generates $4,400 per month. Traditional dividend stocks. $1,760,000 investment for $4,400 per month. Covered call ETFs offer a higher yield, requiring a smaller investment to achieve the same income. However, they come with trade-offs, such as limited capital appreciation due to the call option strategy. Which strategy is right for you? Covered call ETFs provide higher yield income, making them ideal for investors with less capital but a desire for more immediate income. Traditional dividend stocks offer stability and long-term growth but require a larger investment. Consider diversifying your portfolio to strike the right balance of income and growth. Final thought: which strategy aligns with your financial goals? Share your thoughts in the comments. Like and subscribe for more insights into achieving financial independence through dividends.